have the pleasure of having Alejandro Izquierdo. So Alejandro, as I mentioned, is a principal technical leader in research department of the Inter-American Development Bank. Previously, he worked as the regional economic advisor for Mexico and Central America, the IDB, and was formerly the principal economist in the research department. Alejandro was in charge of the IDB's annual macroeconomic report for 4 consecutive years, and his current research interests include issues in international finance, such as optimal levels of international reserves, the role of external factors on growth, the relevance of balance sheets, effects on financial integration in determining the likelihood of experiencing sudden stops in capital flows, as well as how countries recover from output collapses following sudden stops. So welcome, Alejandro. You have 5 minutes, 10 minutes.
Don't worry. Okay, good morning, everybody. I'm lowering this for obvious reasons. It's a pleasure to be here at IFPRI, and I'm very thankful to Eugenio that he invited me to present here for you. We've known each other for more than 15 years now. We were thinking about this morning, and we worked together on projects on Peru, but also when Eugenio was director representing Argentina at the IDB, we had long talks about several topics at the bank, so thank you for the invitation. First of all, let me say before I start the presentation that I think what Eugenio is doing in this book is very important, even though I haven't had a chance to look at it thoroughly. Looking at micro linkages, I think is very important. Usually macroeconomists are on one side and people doing microeconomics on the other side, and they don't talk to each other. Well, I think this book tries to address that issue. So let me move on. Again. Okay. Oh, it's the end, that's why, I think. Let me see if I can do this quickly. All right, this time it will work. Okay, let's see now. Perfect, okay. So Eugenio asked me to think beyond the book and to try to link some of the aspects of the book with research I've been doing in the past few years at the IDB. So I think already Eugenio convinced you that macroeconomic performance issues are very heavily affected by agricultural economics. I'm going to focus on that point first. And then also he introduced the issue of vulnerabilities that macroeconomics can generate. And I'll focus on that point second. I'll be talking from, say, 30,000 feet above. So he had very focused policies on agricultural issues and how they impact macro. I will talk at the very top of the macro level, but still you will see that commodity prices, which is the topic I will handle in this presentation, affect macroeconomic performance. So let me start by showing you work we did a few years ago in 2007 when emerging markets were riding the economy, the commodity boom, and it looked like we were going to grow forever. Now, when we looked at this, the growth of Latin American countries, of the average Latin American country, which you can see with the blue line, it turns out with a model we worked on that with just 4 external variables, which are world growth, commodity prices, and international financial conditions measured by the interest rate on UST bonds and the high yield spread. With those 4 variables, you can explain almost 60% of the variance of growth in the average Latin American country. And as you can see, the green line, which is what the model would predict given those external factors, very closely mimics behavior of output in the average Latin American economy. So indeed, yes, there is an important effect of these external variables. So what Eugenio mentioned, to focus on global conditions first, I think is key. Now, if you want to look specifically at the impact of commodity prices via terms of trade, so terms of trade are the price of exports over the price of imports. Imagine commodity exporter countries. Many Latin American countries take that position. What we calculate is that just a 1% increase in the terms of trade can have 0.11% impact on the first quarter after that increase, and up to 3/4 of a point of GDP after 20 quarters. So yes, indeed, commodity prices do have a big impact on GDP behavior. The other thing I wanted to highlight is that commodity prices squeeze into the fiscal account, as Eugenio was mentioning before, and also into the current account. Let me show you two things we did a few years ago when we basically said, well, the region looks very well, but all that glitters is not necessarily gold, and we have to discount for the impact that commodity price booms may have at the macro level. So first, look on the graph to your left. Here we see the observed fiscal balance of the region on average. This was in the early 2000s. And you can see that if we were to take out the impact of commodity prices and trend output at the time, you would have a very different fiscal picture. And the same holds for the current account. I mean, we turned from very high current account deficits into high current account surpluses, and you can see on average this would be the current account you observed. But if we were to take away the price impact of that current account, when you take that price impact out, you see that we would have moved to a current account deficit position. So a very important impact of commodity prices on key macroeconomic variables. And I want you to focus in particular on the current account, because now we're seeing that happen in the region. Now, with commodity prices having slowed down quite a bit and fallen in many cases, the price of soy, for example, went from $600 per ton to $300, so half the price all of a sudden. Now we're seeing that the region has started growing current account deficits. So why would I want to focus on current account deficits? Because now I want to move into the vulnerability aspect. Eugenio mentioned to you that we, at the macro level, focus a lot on real exchange rate movements. And a key aspect that I want to highlight here is what happens to the real exchange rate when you have a crisis. So when you have a financial crisis, typically you will have a stop in capital flows. So when that stop in capital flows occurs, you don't have any more financing of your current account deficit. And how much you have to close, or how much you need prices of tradable goods to become more expensive in order to close that current account deficit all of a sudden, that's what we study here. And it turns out that under some conditions, the change in the real exchange rate will be equal to the size of the current account deficit adjusted by the demand for tradable goods. So the percentage change that the demand of tradable goods needs to go down is related to what you're going to see happen to the real exchange rate during crisis. And that effect is non-trivial because, as Eugenio was mentioning before, many of these economies are dollarized. So I'm going to show you work we did on how the interaction of a current account deficit and high dollarization may increase the chances that you have a sudden stop in capital flows. The first thing to notice is that, as I told you, a higher deficit in the current account will translate into a higher real exchange rate depreciation if you had a sudden stop. So that's the price effect of these balance sheet effect interactions that Eugenio, I think, also discussed. Now, if you put together high dollarization with in debts, no? With large depreciations of the exchange rate, then you're in trouble because those debts will not be payable. And what we show, I mean, this graphic may not be very easy to see, but imagine that if you go closer to the zero value of the x-axis, you're increasing your current account deficit. So it's flipped, okay? Now, I show you how the probability of a sudden stop changes for different levels of dollarization. So if you're highly dollarized and you increase your current account deficit, you increase the probability of a sudden stop quite dramatically compared to cases where dollarization is low. So again, the interaction of prices and dollar debt are important in terms of vulnerability to this financial crisis. Just to give you an example, when we were in 2007, 2008, getting nervous about what might happen during the crisis after the real estate market collapsed here in the U.S., we, using this very simple model, we asked, well, where was Latin America and Eastern Europe standing in terms of the probability of a sudden stop? And because we had high current account surpluses rather than deficits, and we were relatively de-dollarized compared to the early 90s, then the probability of a sudden stop was quite low. We changed quite a bit compared to the 1990s, both because we were less dollarized and we had current account surpluses at the time. Now, let me show you, I want to show you one more thing here. How these key variables compare in 2007 vis-a-vis 2014. I haven't updated this data, but it's even, if anything, it's going further down. Take a look at the current account balance. By 2007, we were running surpluses, and now by 2014, we were running deficits, and they are higher if I were to do numbers for 2015. And also fiscal balances have deteriorated, and domestic liability dollarization has also increased. So here you have a picture where the fact that we have now much lower commodity prices and current account gaps have widened, the vulnerability to these sudden stops has increased. And that has even further implications if you want to think of what would be the optimal policy for reserve accumulation. Because if you want to prevent these sudden stops, you may want to hoard more reserves in order to be ready to fight one of those crises. And that's the last thing I will show you. If you take a look at 2007, based on work we've done at the IDB, these are Latin American countries. They were pretty much, they were close to this 45-degree line, which shows observed reserves vis-a-vis optimal reserves. No? So what are optimal reserves? In this model, we think of what is the level of reserves that will make it optimal for me to hold to buy insurance against a sudden stop. And what you observe based on that empirical model is that Latin American countries were very well positioned at the time. And again, implicit here are commodity prices, the current account deficit, and the potential size of the shock. So if I were to now show you for 2010, we see that now things got worse because we wanted more reserves optimally than we had. And if I were to show you this with 2014-15 numbers, perhaps it would even go further up. So see how commodity prices, which seem to be something far out there in terms of the agricultural sector, can have heavy impacts on macroeconomics variables and decisions. Thank you.